Good afternoon, everyone. Welcome to episode 7 of Homebuying 101, our lender chat series. Today, we're back to Mark Howard with C2 Lending. Mark's got some great information. So, if you are a buyer and you're out there looking at homes, I think the perception is that we're really getting close to being officially in a buyer's market. So, buyers want to get bargains. But what I would like for you to consider is instead of looking at a home that is priced correctly, and coming in and potentially risk insulting a seller with a lowball offer, why not take a look at how asking for a concession could help you, the buyer, in a much better manner? So, Mark, please take it away.
Awesome. Thanks. Appreciate it. So again, Mark Howard, C2 Financial, wholesale mortgage broker. So let's take a look at how we can utilize some seller credits or seller concessions to potentially buy down your interest rate, and how does that compare to a price reduction on that same home? So before we dive into that side-by-side comparison, let's take a look at some limits. So as you're thinking about making an offer, there are limits to how much the seller is allowed to give you. And those limits are based upon the loan type and the down payment amount. So let me show you a quick cheat sheet that I have that'll walk you through these different limits. All right, can you see that, Pam?
I sure can. Love
Okay.
it.
Okay. So here's my cheat sheet, and we're just going to very quickly walk through this. So first of all, conventional loans, very common, right? Primary and secondary homes. This is going to vary. The limit varies upon the down payment amount. So if you have less than 10% down payment, you're limited to a 3% of the sales price as the max seller contribution. So on a $400,000 house, that's a $12,000 max that they're allowed to give you. Down payment 10 to 25%, 6% of the sales price. More than 25% down payment, 9% of the sales price. Okay. With an investment property, it's limited to 2% always. And a lot of people aren't aware of that, but it's limited to 2%. FHA goes all the way to 6%. That's a really big number. USDA also 6%. And then VA is a little bit tricky. Generally speaking, 4% is the rule that most people are aware of, but in reality, the 4% only applies to certain items. A lot of the items in the closing costs are actually not limited to that 4%. So your normal closing costs, like origination and processing, title fees, those are not included in the 4%. So there's a lot of leeway there, but the general rule of thumb, people just go with this 4% just to make it simple. So that's your limits that you can get from, by the way, it's not just sellers, it's actually technically called interested party contributions. If your real estate agent or anybody else involved in the transaction is giving you additional credits, that's included in these limits. It does not, however, include any real estate commission that may be paid to an agent. That is excluded from these limits.
So
Any
I
questions on
think I was just going to say, I think a good rule of thumb for VA, since it is a little bit more complicated, is before you make that offer or as you're trying to decide the best way to do it, talk to your lender.
It's simple as that. Yeah. And it's pretty rare to go over the 4% anyway. That's a pretty big number. But I have a contract right now that's got 4.5 to almost 5%. Not a problem at all. We're going to use some of that money to do some temporary buy downs and such, and it's going to be fine.
Okay, cool.
Awesome. All right. So that's seller concessions. Now let's move into a buy down versus a price reduction. Okay. So here's a side-by-side comparison. Here's our scenario. We have a conventional loan, 30-year fixed rate. We're limited to a 3% sales price, max seller concession, because I'm going to do a 5% down payment in this scenario. So here's our starting point on this column here. We have $400,000 sales price. We're going to do a 5% down payment for $20,000. That gives me a loan amount of $380. Interest rate, just going to do roughly 6.5 as our interest rate for this example. And then that makes your monthly principal and interest, just the principal and interest, not taxes, insurance, or PMI, just principal and interest, 2402. Okay, that's our baseline. Now, let's take a look at offering 12,000 off of the sales price. That's a 388 sales price. 5% down payment of 388 is 19.4. So you did save $600 on your down payment. That's a nice little perk. Loan amount is now 365, 750. Interest rate is the same, 6.5. Your monthly principal and interest is a little bit lower because your loan amount is a little bit lower. So 2330 would be that principal and interest in this scenario, saving you $72 a month. That's nice. That's a modest savings, but that's nice. The real impact here is the equity in the home, because you have not only the $20,000 down payment, but you have the additional $12,000 plus your down payment for a total of $31,400. So your kind of equity in the home, if you will, is that $31,400. So that's the $12,000 price reduction plus the down payment. That's a long-term play. When you go to sell the house someday, that's real equity in the house that you're going to get back. So that scenario, there's nothing wrong with this scenario, but the monthly savings are modest. Then here's the alternative, taking that same $12,000 and applying to an interest rate buy down, same 5%, same loan amount, but now we're going to buy down to roughly 5.5%. Now, that dollar amount doesn't always equate exactly 1% reduction in the rate, but generally speaking, it takes about 3% to get a 1% reduction in your rate. 3% concessions, 3% of the sales price, 3 discount points is the technical term, to buy roughly 1% off your rate. So at a 5.5% rate, you now have a monthly principal interest of $21.58 monthly payment. That's a savings of $244 per month compared to our opening scenario. That's $172 more per month than our price reduction scenario. So you can see monthly, there's no comparison. Significantly better on the monthly savings. Again, the big difference is the equity in the home that you're retaining with that price reduction. So, but if you want a lower monthly payment, there's no argument. You want to use that money to buy down the rate.
As opposed to
Price reductions.
Okay.
Yep,
All
that's
right.
exactly right. Now to the seller, it's exactly the same number, right? That's an important point. Makes no difference to the seller. It's 12,000 either way.
All right. That's good to
Any
know.
questions, or does that make sense?
No, that makes perfect sense.
It's pretty simple. It's just moving the money somewhere else. And as a side note, by the way, saving $172 more per month in about 6 years, you will have saved $12,000 out of pocket. So even with a lower monthly payment, you're gonna converge, if you will, with this scenario after 6 years. So okay, so that's our buy down scenario. Let's go a little more nitty gritty and take a look at my actual loan software. So this is going to show you the entirety of the monthly payment and the PMI and all those factors here. So let me switch screens 1 second. All right, so this is behind the wizard's curtain, if you will. So when someone applies for a pre-approval, this is the software that we use to work that application and to generate monthly payment estimates, things like that. So this is what it looks like. And this is the same scenario we just talked through, 400,000, 5% down, 6.5 interest rate. And here's our monthly payment estimate over here. So this is the principal and interest of 2402. I added approximate homeowners insurance of 2,000 for the year. Here's some property taxes, roughly 1.9% on the tax rate, 633 per month, and then some MI, which is mortgage insurance, or PMI, private mortgage insurance, $82 a month. So that gives me a monthly payment of $32.84. So let's do a different scenario. We did the 12,000 scenario. Let's do a scenario of like 5,000, because a lot of times that's kind of as far as you might get out of the seller. So let's do a $395 in sales price. We'll still do 5% down payment, and that changed our loan to $32.45. And just to go back to where we were before, 400. So $32.45 compared to $32.84. That's a difference of $39. So we saved $39 on that $5,000 towards the price reduction. Okay. Let's do the same scenario though with the 400,000 now. Let's say we buy that towards the interest rate. Hard to say exactly how much that's going to buy down the rate. I'm going to do a sample of 0.25%. So we're going to do 6.25 on the interest rate buy down for that same 5,000. It might be a little more than that. It might be 6.125. But even at that one, we've gone down to 32.22 for our total monthly payment instead of 32.84. So $62 compared to our $39. So you can see even in that example, we're saving more per month with the interest rate buy down, and that's a month over month savings. While we're on this screen, though, I do just want to draw some attention. So there's a lot of talk about interest rates, things like that. Let's not miss the impact of property taxes. If I took this property tax just from simply a 1.9 to a 2.3, which would be a pretty normal rate, especially in your new construction areas, that takes your monthly payment $133 more per month. If I take it up to 2.8, which is some of the areas as well in the Austin area, you're up to almost $300 more per month. So don't miss the importance of property tax rates as you're shopping for homes.
That kind of piggybacks on last week's discussion that the property tax rate in an older established neighborhood, they're typically lower because they don't have the MUDs and all the extra stuff that a lot of these new subdivisions do. So, there's another vote for why looking at a more established at an older home might not be a bad option.
Absolutely. And when we say established, it's not even, homes from the 70s even. So I'm looking at a new contract right now that is in East Round Rock near Forest Creek, 1.77 on the tax rate, right? So, I mean, and that is, it's a 1999 house, right? And this is a great area of town and all that. 1.77, 590. compared to some of the newer areas, in some of the new construction areas, for example, 2.3, that's $270 more per month. I mean, this is a huge difference so what that means is you can buy more house. So let's look at this difference real quick while we're here. So a $400,000 house at 33.55 at that tax rate, how much house can I buy for 33.55 at a tax rate of 1.77? Watch this.
Yeah, that's significant.
Quite that far, huh? So what, 422, something like that. So I've added $22,000 to my sales price, or $21,000 to my sales price to get roughly the same payment just by taxes alone.
Just so buyers know, when we set up a search, if we need to be that fine-tuned on numbers, we can look for homes with tax rates below a certain number.
Oh, you can set that up in your MLS search.
Yes, we can.
That's awesome.
Yeah.
That's super useful. Yeah, there you go. So that's it. I mean, that's kind of what we wanted to cover. I mean, just some ways to get those monthly payments a little more reasonable, the comparisons, and then just a little bit on property taxes.
Mark is with, again, C2 Financial as a wholesale lender. Mark has lots and lots and lots of options, pretty much has the gamut as far as companies that he can go to. And as we've talked about before, Fannie and Freddie have their guidelines, but every company has their own overlay. So
That's right.
give Mark a call, talk to him about your situation. And, we've said this before, but just be completely honest and upfront about your situation and everything, because he's going to be working for you and trying to help you find the best for your situation. And the worst thing in the world is for him not to be given all the information only to find out you found the house you love that's in that price range. And then when it gets to underwriting, it's like, bam, there's a surprise. So we don't want
That's exactly
surprises in
right.
this process.
We do not want surprise. That's exactly right. And we can work through those difficult scenarios, even get things looked at by underwriters in advance and find you a solution before you start spending money on a house.
Exactly, because you do have those upfront fees when you're getting into contract, which I will cover in a separate buyer class. Thank you. And if you have
I
any
appreciate it, Tim.
questions, our phone numbers will be at the end. Please feel free to give Mark a call anytime with your questions. And this includes for refinances too. If you got stuck with one of those 8% mortgages, give Mark a call. He can save you some money.
That's right. Thank you, Pam.
All right. Thanks. Have a great day, everybody. We'll see you next week.